Fiona.
Hello, Fiona.
How are you?
Yes, I'm good. Sorry, I just got little late because our road is under repair, so I had to pull the car up and down. Now ready.
No worries. That's
yeah, now ready. It's all right. Okay. Right. Can we start?
Yes, yeah.
We want that Marchand group, that big question. I think we came up to a particular point. Shall we again just summarize the revenue? We will take the 400 plus 115 plus half of option, but minus the 12 intercompany sales. We will take the revenue 400 plus 115 plus 35 minus 12 will be our revenue, which is going to be 538. Did you get that figure?
538.
Yes, correct.
Yes.
400 115 plus 17 minus 12 plus 35 minus 12. Why are we taking 35? Because the option was a subsidiary only half a year. Right? Because
halfway through the year.
They sold a controlling interest, they sold a part of it, and after that it is no longer a subsidiary. Cost of sales will be 312 plus 65 plus 18 minus 12. The cost of sales will be 383.
Yeah, we've got that.
Then we had the GP coming up to 155.
Yeah.
Then the other income, we had couple of adjustments on the merchant. One was that what are the figure? That was that on the sale of the subsidiary, the sale of not the subsidiary, the part 8% what they sold, they made a gain, and that gain came to, if I remember right, that gain came to how much? That gain.
There's
I
22.
How much was that gain that what we had when they sold it? They had a gain of 5.3 million. Right?
Yeah.
The 5.3 million, they have shown it under P&L. We know it is not a P&L item because it is, since it's not a sale of a subsidiary, but still being a subsidiary, the gain should be shown under other components of equity. So we have to remove 5.3 from the other income of margin.
Yeah.
Then of course the gain on the sale of the subsidiary, the other subsidiary option, which they really sold it, there was a gain which they have not accounted for. That gain came to 22.
Yeah.
22. So that we have to add it up. So 21 minus 5.3 plus 22 plus the Nathan 7 option, we only have one because half of the year. So all that will give us 45.7.
Yes.
Other income, right? Okay. Then administrative expenses, we did not have any problem. 15 plus 9 plus 630.
Yeah. Yeah.
So that was also all right. Administrative expenses. Other expenses, we had few items. So we were trying to work out on the other expenses because everything should be included on the other expenses. But before that, we go into few of the other areas that we worked it out. One of the associate income, associate share of profit of associate company, we saw it as 1.5 million. How did you get that one?
Yeah.
The total profit for the year of option was 7.5 million. The total profit of the option was not 7.5 million. Total profit of the option was for the year was 15 million. The half year it was 7.5 million, right? And our interest is now only 20%, and therefore our associate share of income was 1.5 million.
Yeah.
So that's another thing that we got, 1.5 million. Then we had few adjustments. One was on the impairment of goodwill. Remember, the original impairment was from 15, 20% was 3 million. But what they have done was, later on they have revalued the goodwill and they have wiped off the 3 million and they have taken another 2 million plus as a kind of a credit. But we know goodwill cannot be revalued upwards, and therefore that entire 5 million, that what they have done upwards must be completely removed.
Yeah.
Right. So on the impairment of goodwill, we have to put another 5 million figure. So I'm going to take all those figures separately because all that figure should be under other expenses. So there's a 5 million expenditure which I have to include it under impairment of goodwill. Then also there is other expenses here, 35 plus 19 plus 4. 35 plus 19 plus 4, that is 54 plus 4, 58.
Yeah.
That also we have to include it under other expenses. Then we had the net service cost in the pension fund. There was ultimately a 9.2 million. 7.2 million should come under P&L. The 2 million will come under other comprehensive income. The reason being, we have taken the option to show pension costs have not been accounted in the total comprehensive income. So the remeasurement loss in the year end at 2 million should be always other comprehensive income. So therefore 7.2 million will be in the P&L part, 2 million will be in the OCI part. So I will have to include another 7.2 here under OCI. That also we work it out. Then property, plant and expenses, you remember, have you got the figure 2.36 what we got?
Yeah.
That was because of the impairment. There was a 4 point something impairment. But since we have already revalued the figure by 2.2 or something like that, we can eliminate that one, and the balance part we have to write it off to the P&L, and that came to 2.36.
Yes. Yeah, I've got that.
Yeah. Then the share option, it was very easy. I think it came to 2.13. The difference between the beginning figure and the closing figure. Do you remember there were 4 directors were thinking of leaving, but only one man was leaving, and there was a 2.1. Did you get that figure?
Yes. Yeah, that was the balance for 2014. Yeah.
That's correct. Yes. So 2.13. So altogether, all these figures, 58 plus 5 plus 7.2 plus 2.36 plus 2.13 should give me my total other expenses.
Yes, I hadn't written that on the P&L, but I think that was just where we kind of left off,
Exactly.
wasn't it?
That's right. That is where we left over. So now I'm working beyond that one, but for the moment, the P&L other expenses figure should include all these 5, 58, 7.2, 2.36 and 2.1. So what's the total of that P&L other expenses figure?
So adding all of those together, it comes to 74.7.
74.7, exactly. 74.7, you are right. 74.7, so other expenses. So we have got the revenue figure 538, we have got the cost of sales 383, we have got the gross profit, then other income was 45.7, administrative expenses minus 30, other expenses 74.7, share of profit of associate company 1.5, that will give my operating profit. So can you work out that one? Revenue 538.
So that's 94.5.
94, 97. I think you
Yeah,
deducted the share of profit of it. Should be an income 1.5.
Yeah. Oh yeah, 97.5.
97.5, that is your operating income. 97.5. So that is the figure that you will come up to. So if you can come up to this point, we are done very well. Now the next one is the finance cost. Finance cost, will there be any adjustments? Finance cost, finance cost, what are the adjustments what we have? Finance cost, we have a 5 and a 6 and a half and a 2. Right? The finance cost should be 5 plus 6 plus 2. That should be, no, how much is that? 5.
10.
Yeah, finance cost. How much is that altogether? Finance cost in the PNL. We had altogether originally 5 in the main PNL. Another 6 in the second one.
Yep.
And another 2 in the other one. 13 altogether. Agreed? 5 plus 6 plus 2.
Yeah, 13.
13 altogether. Now, you remember the finance cost is 13. You are right. So finance cost should be 13. Then we have another little item. We can talk about the finance income also straight away. What is finance income? 6 plus 5 plus 4.
Yeah.
15. We can talk it. I want to look at this one little adjustment. Think of this number 8. A loss on effective cash flow has been included in the subsidiary's finance cost. Where should it appear? Any hedging effective cash flow has been included in the subsidiary's finance cost. So when the subsidiary says the Nathan, when it says the finance cost is finance cost is 6, it includes this $3 million. Where should it get included?
That should be in the
Where should it get it included? Yes.
should be in the OCI, shouldn't it?
OCI, you are right, exactly. Yes, OCI, it should get included in the OCI. So my 5 plus 6 plus 2 should get reduced by 3 million. My finance cost must get reduced by 3 million.
Okay.
Reason that finance cost, that was a very tricky one, simple one, but a tricky one because I didn't read it as saying it is included in the subsidiary finance cost. I knew there was something on the hedging, but I did not realize that they had gone and included in the finance cost. So my finance cost should be 5 plus 6 plus 2 minus 3 should be only 10.
Okay.
Right? And that other 3 should appear under OCI. So now, for all purposes, as far as my P&L is concerned, now I have put the 5 plus 6 plus 2 and also the finance income. So now I can get my profit before tax. You started with 97.5 operating profit. Now you have a finance cost of 10 and a finance income of 15.
Yeah.
So what is your total profit before tax?
102.5.
102.5. Now the next one is a very simple one, income tax. There are no adjustments for income tax. Income tax will be 19 plus 9 plus 2.5. 19 plus 9 plus 2.5.
Yeah.
So now we can get the profit for the year. Which is a very important figure. Profit for the year, we will get it.
So that then is the 72.0.
Yeah, 72.0. That is your profit for the year. So remember, in the consolidation, this profit, this is profit after tax. This must be split between the parent and the non-controlling interest. That we will do it in a minute. But before that, now we must include the OCI. We must include the OCI. So what are the items that will come under OCI?
I've got two so far. The
Okay.
loss on the cash hedge flow, 3.
Very good.
And
Loss on cash hedge flow, 3. Very good. Yes.
And the remeasurement of the defined benefit plan.
Yeah. How much was that one? On the remeasurement of the defined measurement, 2 million.
Yeah.
Right. 2 million that you will get it there. And also you have that, what is this, loss on cash flow hedge, 3 million coming up.
Yeah, the cash flow hedge, yeah. I haven't got anything else, I've got those two.
Yeah, now look at little bit more. We have a revaluation of the comprehensive income. In our own parent P&L, we have a 10 million figure. In our own P&L, we have a 10 million figure. Yeah.
Okay, that's over the page.
But yes, but can we take the entire 10 million? Now, what is the problem there? You remember, so just start with the 10 million, parent company 10 million. I'm going to start with that one.
Yeah.
10 million figure. But you remember, what did they do when the Nathan investment went from 90 to 95? They have created a revaluation. So this revaluation reserve includes that 90 to 95 when they went from 90 to 95. Number 2, carrying value of the investment in Nathan was 90 on 30th April, and on 30th April 2015, 95 million. So this 5 million they have included surely under revaluation reserve.
Yeah.
So your 10 should get reduced by 5. Not easy to think in the exam, no? 10 you must get reduced by 5 immediately. What's the other adjustment? Now that the other adjustment I know no student will be able to keep up in mind, unless what I suggest is when we are doing all these work-ins, revaluations, etc., we do all these simultaneously. So if I was sitting for the exam, what I'll do is I will open up the revaluation, OCI income 10 million. Immediately when I know 95 to 90, I will go and reduce that one. I will keep another separate working sheet for that one. And you remember, we did something on that property, plant and equipment.
Yeah.
That was something which went to the originally into the revaluation reserve, which we reversed it. Right? Which we reversed it. Because the total impairment was something bigger than what we put it in the P&L. The total impairment came to, if I remember right, the total impairment came to total impairment came to 4.56. We charged in the P&L 2.36. Why? Because there was a 2.2 earlier revaluation reserve. So now we have to remove that one. So your OCI will come down by another 2.2. And ultimately, the revaluation reserve will be 2.8. Now the revaluation reserve, the OCI will be 2.8. Parent company shows 10 million, but we know we can't take the 10 million. We have to take only 5 million because that other balance 5 million is a wrong accounting entity, not wrong accounting entity in their own company book. But when you are consolidated, we must remove that 5 million. Second one, we have reversed the 2.2 million revaluation reserve. That need to go to the OCI 2.8 million now. Now, again, if you go back to your own P&L, the consolidated P&L, I'm going to start with the top figure. revenue 538, cost of sales 383. Can you check and see whether all those figures are there with you?
Yeah.
Right. Then the GP is 155, other income 45.7, administrative cost minus 30, other expenses 74.7, share of profit of associate company 1.5, operating profit 97.5, finance cost minus 10, finance income plus 15, profit before tax 102.5. Income tax expenses 30.5, profit for the year 72. Have you got all those figures?
Yeah.
Right. Then now we include OCI. OCI we have revaluation surplus 2.8 plus defined benefit plan minus 2 and cash flow hedge minus 3. The total other comprehensive income will be 2.8 minus 2.2. Have you got the figure? Minus 2.2. 2.8 plus minus 2 minus 3. Did you get it?
Yeah. 1, 2, 3, 4. So is it a minus or a plus?
Yeah, minus 2.8 is a plus figure, but we wrote off 2 million for the defined benefit and another 3 million for the fair value hedge. So it should be a minus 2.2.
2.2. Yeah, it's confusing me because the other revaluation was 2.2.
Yeah, that's correct. Yeah. Right? Yeah. So now it's a minus 2.2. So you remember our P&L figure was 72. Now here we have a 2.2 minus and your total comprehensive income will be 69.8. Total comprehensive income will be 69.8. Agreed?
Yeah.
Now what we have to do is we have to split the 72 between parent and the NCI. We have to split the 69.8 between parent and the NCI. Remember, we don't split the 2.2. We split always the profit for the year and total comprehensive income. 72 and 69.8 we need to split it. So the splitting what we do is we look at the non-controlling interest part. So we have to look at the non-controlling interest part for both these subsidiaries, and let's look at that one. That is a very, very important adjustment what we are going to look at now, the non-controlling interest part of it, right? So let's look at how we can work out that total non-controlling interest. Now, first of all, let's look at the company, the first one. First look at this company. We have to look at the profit before tax of the first company. Let's look at where we have a holding of 60% minus 8. We have a holding of 52%. So let's look at that one. So we have a profit before profit for the year. They are of how much? 19 million. 19 million is the profit for the year of the company, but I can't go by that one. I must go by my workings. Let me see my workings. Let me see my workings and see whether I can get the figures now rightly. So Nathan's company, what is the figure we have? We have 50. I'm looking at Nathan's now. 50, administrative cost 7 is all right, and other incomes 9 is all right, other expenses 9 is all right, Then finance cost, we have a 6, that's all right. Finance income, we have 5, all right. The only correction what I had to do is, I had to bring that cash flow hedge loss, which they are shown under finance cost, because it's not a finance cost. So because of that, my finance cost must get reduced by 3 million, and therefore my profit of this company will be how much? Nathan, this finance cost will have to get reduced by 3 million. In other words, finance cost should be 3. Right? Because the balance should come to the bottom part of it, already which we have included. So, your profit for the year will be 22. Agree?
I'm not sure, just working it out.
Yeah, what I did was I took right up to 29, no problem. You remember the hedging finance loss, they have included in that 6 million, they included that 3 million. Hedging finance loss, they included under finance cost. That is why we earlier when we were doing the consolidation, we took 5 plus 6 plus 2, 13, but we removed the 3 and we said the finance cost is 10. Can you remember that one?
Yeah.
Right. So why did I remove that 3? Because this 6 million what is stated as finance cost is overstated by 3 million. Because that 3 million should go to the bottom, to the other comprehensive income. Look at the note number 7.
Yeah.
Note number 7, what is it saying? Note number 8, a loss on effective cash flow hedge of 3 million has been included in the subsidiary finance cost, which is wrong.
Yeah, so take that. So is the answer 22?
Exactly. The profit will go up to 22. Okay? Profit will go up to 22. Now, that profit 22, remember, up to 6 months, we had 40% NCI.
Yeah.
Right? Up to 6 months, we had 40% NCI. And after that, we have 48% NCI. Agreed?
Yeah.
Because we sold 8%. Right? So now we have to look at the whole thing and to see what we have got as NCI. The first 6 months, it is 22 into 40%. The 22 is the total profit. Of the total profit, we have to assume it is equivalent equally. So 11 million for the first 6 months and 11 million for the second 6 months. First 6 months, NCI was only 40%. So they are entitled to 40% of 11, 4.4. Second 6 months, they are entitled to 48% of 11. And 48% of 11. So 11 into 0.48, how much? 5.3.
I'm not getting that. Oh yeah.
40%.
Yeah, 5.28, 5.3.
Yeah, because what happened was they let me see the sum again just to see whether we are all right. Merchant disposed in Nathan on 30th for a cash consideration of 8. Sorry. Nathan, what happened on 30th of April 2014. 2014, 30th of April is the day we are preparing financial statement. So it's not half year, whole year. Right? Our financial statements are prepared on 30th of April 2014.
Yeah.
This is why I always say on the top of your working paper, write the date of reporting. Otherwise, you might miss it. So, it was sold only on the 30th of April 2014. So, whole year it was a subsidiary. Agree?
Yes.
Whole year it was a subsidiary. So, not a 40% and a 50% and all that. So, whole year the NCI had 40% interest. Right?
Yeah.
The whole year NCI had a 40% interest. So, 22, 40% of 22, 8.8 is the NCI in the subsidiary Nathan. Are you with me on that one?
Yeah.
What about the NCI in option? NCI in option. How much is that one? NCI in option. NCI was a subsidiary only for half a year.
Yeah.
If I remember right, there were no adjustments in the option accounts. So option, they had a profit of 15 million. There were no adjustments, no erroneous entries, nothing, thank God. So on the 15 million, for half a year, they had a NCI. So 7.5 million was the profit they made during a subsidiary time. And of that 7.5%, those people are entitled for 40%. Because in that company also, we had a 60% interest. Right?
Yeah.
15 million is full profit. We were subsidiary only for 6 months, so 7.5 million. 7.5 million, 40%, 3 million. So total NCI in both the companies in this profit is 11.8.
Okay.
So out of 72, which we got a 72 as a figure, what we had to do is we had to split that 72, we had to split 11.8 to NCI and the balance in figure to profit attributable to parent.
Yeah.
72 was the figure, 72.0. 72 minus 11.8.
Yeah, 60.2.
60.2 we will say owners of the parent, but remember in the presentation we put that on top owners of the parent, 60.2, and non-controlling interest 11.8. That's how we will balance the 72.0. Okay?
Yeah.
Now we come to the second part, TCI. TCI, what have we got to do on the TCI? TCI was not 72, TCI was only 69.8. So again, what we have to look at is, we have to look at the entire total comprehensive income and see how much belongs to the NCI, how much belongs to the balancing part is to the parent. So can you see whether you can work out that one, Fiona? The TCI part. TCI, we have got a figure of 69.8, but go to the subsidiaries and see whether any of the subsidiaries are affected.
Yeah.
Yes. Who is affected? Nathan is affected, isn't it?
Yeah. Nathan, yeah.
Nathan, which was 22 million. The Nathan, which went up to Nathan's 3 million, that loss should be under TCI. So
yeah.
Nathan's TCI will be not 22, Nathan's TCI will be 19. Agree?
Yeah.
19. Of the 19, 40% will be the figure. Parent company, we have no problem. Only if the subsidiary TCI there is something. So we have, although in the original account we did not have, but because they have wrongly accounted the hedging, we have to remove that 3 million, put it down. So because of that, now we have that the 3 million coming down. So the TCI is 19. 40% of that is 7.6.
Yeah.
And the other one, no problem. There are no TCI adjustments. So that same 3 million will remain. So the total will be 10.6. Total NCI will be 10.6. So what is the balance to the parent? 69.8 or something was the figure, no? What are the figure? 69.8 minus 10.6. We will show it on the parent. 59.2. So what I want to understand, it was a difficult question, too many adjustments to do. It would have been a very, very difficult one to do it in about 50 minutes time, this question. But what I need you to understand is the first start of putting up the structure, the pro forma. Revenue, cost of sales, cost profit, other income, administrative cost, other expenses, share of profit of associate, operating profit, finance cost, finance income, profit before tax, income tax expenses, profit for the year, and then go to the other comprehensive income. What I would suggest is you will do this question on your own, keep in all the working papers. Open up working papers just as you want it and in many sheets so that you can go and write the corresponding entry wherever. The moment you remove, the moment you adjust the revaluation, go and do the other comprehensive income. The moment you do the defined benefit plan, go and do it in the other comprehensive income. Like that, if you do, you might not be able to balance it 100%, but surely still you will be able to get closer to the answer, and the examiner will see all the workings because you're going to attach all the workings, he will see and he will give you marks.
Okay.
So I will try to send you an answer for this one, so that I'll try to give you a kind of a presentation and a working how it can be done. The main couple of things to understand in this question, there were it was too much of information. The big thing was that about the revaluation, I think, right? In the parent company there was a 10 million revaluation, but we realized that they have brought the 5 million, which is not wrong. In their company books they must bring the 5 million, but when we are consolidating we have to remove it. 90 to 95, 95 to 90. Then the property, plant and equipment, we impaired it by 4 point something, but what was in the revaluation we could take it up. But I think the bigger adjustment for me was that wrongly treated goodwill adjustment. I don't think many students caught that one, because what we have to understand is according to IAS 36, IAS 38, no goodwill upward adjustment can be done internally, because the intangibles cannot be increased for internal generation. It can be increased only for externally bought intangible. So here the goodwill which was impaired by 3 million, what they are going to do is they are going to write off that 3 million and also bring another 5 million which is wrong. Once it is impaired, it is impaired. Right? Once it is impaired, goodwill is impaired, it can never be revalued and brought in back. So that entire 5 million we have to reverse it. So that is what we have to do and completely knock off that 5 million. Right. So that was a fairly tough and a good question. Actually, this is June 2014 paper.
Oh, was it?
Huh?
Yeah, it's a lot to do in the time, wasn't it?
Yeah, it's too much. It's too much. I mean, it's very heavy on the stuff. So I think what we must do is try and do more P&L ones, more P&L ones.
Yeah. Yeah.
Because I think because the balance sheet, we have some kind of a way to work out the goodwill, NCI, something, and some amount will show. But the P&L, with all these adjustments, you can get stuck. So we will do a little bit more P&L as the time goes on.
Yeah. Okay.
I want to look at the second part. This is typical SEC examiner's questions. Directors of Marchant have strong views on the usefulness of the financial statements after they are moved to international financial standards. They feel that IFRS implement a fair value model. Nevertheless, they have the opinion that IFRS are failing users of financial statement as they do not reflect the financial value of an entity. Now, this is, I think, it has 9 marks, very, very difficult to think what are they asking from us.
Yeah, what are they expecting?
Exactly. Discuss the director's view about as regards to use of fair value in IFRS and the fact that IFRS do not reflect the financial value of an entity. This, I think, is a very, very nasty 9 mark because to understand this kind of the thinking what they are having is not very easy. But I want to discuss this one with you. What is the objective of the financial statement? We know the objective of the financial statement is to give useful information for the variety of users of financial statements to make economic decisions. That's the main idea of the financial statement. That is what is defined, the definition given in the accounting framework. Right? So now the question is, the IFRS using, they say, they feel that IFRS implement a fair value model. Now we must understand what is a fair value and what is the other model. What is fair value model? What is the other model, if at all? What is
It would
fair
be
value model? The balance sheet, the
historical.
statement of financial position,
Yeah.
the IFRS also feel it should reflect the fair value. So that is why IFRS 13 has come, fair value measurement. It was basically to solve the problem in the application of the value concept, the fair value concept. Because we know right at the moment we can either use the fair value concept or we can use the historical value concept.
Yeah.
Right? Remember the IAS 16 permits us to measure the to have a combination of fair value and historical cost method. One category of the property, plant and equipment, you can have both the methods in the same balance sheet, same company. Some assets you can't have in the same category, you can't have different bases, but say property, you can use the revaluation method. Plant, you can use the historical cost method. So that is permitted in the IAS 16. So at the moment, the present system has a kind of a mixed system of measurement using a combination of fair value and measurement of depreciated assets, measurement of historical cost. So for example, if you know, you can quote IAS 16.
Yeah.
Right? So basically the accounting standard body, what we call International Accounting Standard Body, it bases a standard on the business model and the profitability and the probability of realizing the assets and liability related cash flow through operations or transfer. That is what they want to measure. The statement of financial position should reflect what they can be realized through the cash flow or through operations. That is what they expect into the financial statement. So fair value, definitely once it is used in the financial statement, it will affect the performance management. It will affect the performance because you have to bring all the assets to the fair value. You have to provide increased depreciation, and that will definitely affect the performance management and even the net assets. Of course, it will improve the disclosure because everything is at fair value and it will be something more realistic and more practical or more realistic, I would say.
Yeah.
So the idea of IFR 13, the IFR 13 is a new, IFRS 13 is a new standard, what we call fair value measurement. Basically, the idea was to bring this concept of fair value into the forefront. Because most of the IFRSs don't require that assets and liabilities should be valued at fair value. They can value most of the assets and liabilities at depreciated or historical cost, except, this is very important, except when at the time of acquisition, all assets and liabilities must be brought under fair value. That is why we do in the consolidation, you remember what we call fair value adjustment. IFRS, all IFRSs permit to bring us the historical cost, except at the time of acquisition, all assets and liabilities should be at fair value. Right? So that is one standard which permits or which allows or which forces for us to use the fair value concept. Now this is what the examiner was talking. Examiner was talking, is the IFRS useful in making these fair values for the business? We know, yes, in acquisitions we have to bring the fair value. Under IAS 16 property, plant and equipment, we have the option to bring the fair values. IAS 16 property, plant and equipment, we have the option to bring the fair values. IAS 40 investment property, what do you think? IAS 40 investment property, there again we have an option to measure at fair value and any corresponding changes in earnings to be reflected in the P&L. Right? So IAS 40 also gives an option. IAS 16 also gives an option. IFRS 10 consolidation and IFRS 3 business combination, no option, all must be brought at fair value.
Yeah.
IAS 38 tangible assets allows the measurement at fair value with corresponding increase in equity, with corresponding increase shown in equity. Only thing, it has a condition. Now I want you to know the condition. If there's an active market and if you can have a reliable valuation. So IAS 38 permits intangible assets to be shown at fair value, provided it has an active market and it has a way of measuring the fair value.
Yep.
Now, practical purposes, it's very difficult because most of the intangibles don't have a active market and it is difficult to measure the fair value reliably. So even though IAS 38 permits the fair value measurement, it is not practically applicable. I was having a chat with the ACC examiner on this one. He was specifically looking for this part of the answer. That is to say, IAS 38 allows the measurement on intangible assets because there was an article by one of your examiner about this item, right? And he was testing straight away on this item. So what it says is, yes, IAS 38 permits, but the applicability for practical purposes is very limited, very restricted, because you have to go by two conditions. One, it must have an active market. Other one, it must have a reliable valuation. Both are not possible to achieve, and therefore IAS 38 will not apply most of the time. Now we have from January 18, we have a new standard, IFRS 9. Any idea you have about IFRS 9 and financial instruments, Fiona?
Not off the top of my head, no.
Yeah, because earlier standard on the financial instrument, we had 4 categories. You remember? Fair value to profit or loss, held to maturity and loans, held to maturity, loans and receivables, and finally nobody's child, where it won't fall into any category, we put it under available for sale. But now IFRS 9, basically, because earlier it was IAS 39, but now it is IFRS 9, it has only 2 categories, amortized cost and fair value. Right? Earlier, there were different methods and all that kind of a thing, but now we have only 2 values, either amortized cost or the fair value method. So, classification under IFRS 9, these are the new standards that are coming up. We will discuss this one. It's implementing from January 18 compulsory, but most of the companies are doing it even now. So therefore, it can be applied even today, IFRS 9. So IFRS 9 basically says a financial asset is measured at amortized cost if 2 criteria are met. The objective of the business is to hold the financial asset and to collect the cash flows, and the contractual cash flows under the instrument solely represent payments of principal and interest. So, in other words, what it says is, so long as you hold the instrument for purely to get the future cash flows, that must be measured at amortized cost.
Okay.
So, most of our financial derivatives. What are these financial derivatives? These are hedging instruments like options, swaps, etc., etc. Now, they don't have an initial value because normally if you enter into a forward rate agreement or a swap or anything, there is no initial cost, right? Initial cost. Now, because of the IAS 39 and IFRS 9, they will be measured at fair value, the cash flows, the fair values will be measured. So again, we can see IFRS helping in some way to move towards the fair value concept. Not necessarily 100%, but it is moving towards the fair value concept. So the director's view about use of fair values and the fact that do not reflect the financial value of an entity, we have to discuss with many standards and say some standards is moving towards the fair value, but it has some practical limitations, and surely that's the right way to go forward. So there will be more developments happening, but because we believe it will show a better picture of the company's financial position and company's performance. The unfairness of this is solely when 2 companies prepare on 2 different bases, one on the fair value method, the other one on the historical cost method, it can have massive differences in the comparisons.
Yeah.
So this is what I think they need to bring some kind of a uniformity and do something about it. Hopefully it should happen, but before that you must get through the exam, because all these things means more complications for you.
Yeah.
Because every year, every 6 months, every 1 year, these people go and either change the accounting standards or go and change the syllabus, and every time it's a more complication for the students. And now they say, according to the latest research what they have done, the admission to the accountancy profession, the student numbers are decreasing rapidly.
How are they?
Yeah, they have done a research and they have found all over, CCA, CIMA, all over, the numbers are rapidly reducing, the number of people joining the accountancy profession. No doubt, because I think both these institutions are more money conscious. They want to make money at the expense of the students, and they keep on failing the students, asking all unwanted, confusing questions. and surely people
Yeah.
are moving into other areas because there is this HR and so many other new areas that is growing up, and the IT people are going into
Yeah.
those areas. Even marketing is catching up compared to the accountants. SIMA has already started a lot of work knowing that their market is down. SIMA is doing a very active marketing in Middle East market, doing lot of free courses and all that, offering the students to come and join them. ACCS so far nothing at all, but both the institutions, they know that they are facing a stiff competition from the other professions.
Yeah, the exams, well, certainly the ACCA exams are very tough. They're
Very
not
tough.
easy, are they?
Very tough.
Yeah.
Very tough. Very, very difficult to, because the problem is they don't understand that it's a 3-hour paper and it's under examination conditions. Even if you know, it's not easy to put all those things, your thinking cap, and put all those things in that kind of examination condition.
No, that's it. And in the real world,
Yeah.
you'd look thing up, or you'd have more time. You wouldn't be
Yeah,
so time.
because today we live in a world, we can, even if it is some urgent work in office, you can still access to the internet, find out something. You can just go and see what is IFRS 13. That kind of
Yeah.
access is there. So even I do a lot of work for our Prime Minister in Sri Lanka, but whenever he asks something, I'm not supposed to memorize everything and say. I can just on my tab, I can just put IFRS 13, find out what it means, and I can tell him. And that's the way the business sector works. That's the way the government works. You are not supposed to memorize everything, and even if I know it in memory, I don't answer when my Prime Minister asks a question. I will always, just for reference purposes, go back, test it, and see whether it is all right, and then give the answer. And that's the way the companies work today. So this kind of a thing is absurd, the way that they are working on these things. I hope they will change it. But at the moment, things are not looking very good for these two professions.
No, I think the examiner looked like he was quite kind in the last exam, because the pass rate seemed to be a lot higher than it normally is.
Yeah, I think that is what they have done. Both the institutes say they have done that one. SIMA, because they were marking out of 150, and they said 90 is the pass mark, but this time they have brought it to 80. So,
really?
Yeah, and the numbers have increased. I think that is what they are doing. They are making the paper tough, but I think when it comes for the marking, they are much more lenient, I suppose.
Yeah, I hope so.
yeah, I think I think at least something sensible for them to do. Let's look at the third part of this, Ase. This was okay. This part was all right. Marchand plans to update its production processes, and the directors feel technology-led production is the only feasible way in which the company can remain competitive. Now, this is a good statement for another answer for some other question. Always, it is the technology-led production that is bringing good results. So that is why lot of R&D should be done, and that is why we need to spend lot on R&D, and the IS 36 needs to be applied on the research and development expenditure. Marchand operates from a leased property, and leasing arrangement was established in order to maximize the taxation benefit. However, the financial statements have not shown lease asset or liability today. So probably you can see the IAS 17 is the relevant standard for leasing. It says if it meets the criteria for a financial lease, the assets should be shown under leased assets, and the corresponding liability should be shown, right? That is what the IAS 17 said. You remember when we did the cash flow, we had that scenario where we had the leasing and current liability component, non-current liability component in the earlier question. But here, they seem to be not applying that one. So either it has to be an operating lease, or that's the only reason why we can just keep it away from the leased asset. A new financial controller joined Marchand just after the financial year end of 30th April. So remember, we just prepared the financial statements for 30th of April, and is presently reviewing its financial statements to prepare for the upcoming audit and to begin making a loan application to finance the new technology. The financial controller feels that the lease relating to both the land and building should be treated as a finance lease, but the finance director disagrees. The finance director does not wish to recognize the lease in the statement and therefore wish to continue to treat it as an operating lease. The finance director feels that the lease does not meet the criteria for finance lease, and it was made clear by the finance director showing the lease as a finance lease could jeopardize the loan application. Discuss the ethical and professional issues which face the financial controller in the above situation. So here you join the company as a new financial controller. You think these assets must be coming under finance lease, but right at the moment they treat it as operating lease. The finance director feels you should not bring it, because if you bring it, it's going to jeopardize the loan application. How can it jeopardize the loan application, Fiona? Bringing the
because
yeah.
it will show the obligation, the
It will
liability.
show the obligation, it will show the obligation, it will show the liability, and the gearing will go up, isn't it?
Yeah.
Gearing will go up. And that is why I think he's doing this one. He wants to be hiding the real true position. Right?
Yeah.
So we have to first discuss, let's discuss about the professional issues. The professional issue. The professional issue is simply we have to maintain our professional competency. Any lease should be classified as a finance lease if substantially the risk and rewards are with the lessee. Right? Any lease should be classified as a finance lease if the risk and rewards substantially are with the lessee. In that case, the asset should be shown and the corresponding liability should be shown.
Yeah.
Anything that is not falling into the finance lease category will be operating lease, and in operating lease, the lease expenditure will be charged to the profit or loss. What applies is not the legal form, but what applies is the substance over form.
Yeah.
Right? So there are certain criteria that had to meet a finance lease, and basically if those criteria are met, it should be all to do with the risk and rewards. If that is done, it must happen like that. If it is not so, it is unethical, not illegal, but it is unethical, the percentage.
Yeah.
So we as professional accountants, we must make judgments, apply our skills and knowledge to make an informed decision with all our inside information in the interest of the general public, because they are not aware of all that inside information. And in terms of ethics, professional accountants are believed to be objective. In other words, we should be independent and should not be affected by business pressures or top management pressures. The code of conduct of any professional body will set its boundaries and we should stay within those boundaries. In this case, the finance director should not place the financial controller under any undue influence or undue pressure in order to influence his decision. If the financial controller feels very strongly that the lease should be classified as a finance lease, in that case he must make representations to the internal governance authority, in this case the board of directors, and in no circumstances should bow down to the pressures of the finance director. Now this is what is expected of all of us.
Yeah.
This is what is expected of all of us. Right? So this is what we should always think about in this kind of a question, and just go through like that. Right. So this is what we need to look at a question like this. That part was all right. That 6 marks was all right. Could I collect a little bit on that one? 9 marks was a bit of a tough one. 35 marks. I suppose 35 marks, we could have gone for about 25, 28, 7 marks. Should have been all right. So long as we can get anything more than 17, should have been all right.
So that other, there's another sub question, isn't there? The A part 2, explain with calculations how the sale of the 8% interest in Nathan should be dealt with. There's another 5 marks here.
Yeah. There was another 5 marks there. Yeah, correct. Yeah, explain with suitable how the sale of it. That one actually we did that one. You remember that that's how we calculate that 3 point something. That when we calculated that one only, we got that 8% sale was bringing us 5.3. 18 million was the total sale value. 5.3 million we got.
Yeah.
That is that calculation. The total selling price was 18 million. The total consideration was 18 million. Consideration what they sold was 18 million. The fair value of the asset was 95 million. That cost was 60%. So we worked out for 8% what is the value. That is what we dispose. So 95 divided by 60 into 8, 12.66, 12.7. So this was the gain that we reflected. This being still a subsidiary, this gain should be reflected in the other components of equity. Not under P&L. That is why we removed that 5.3 from the P&L and charge it to the other components of equity. Can you remember that part of it?
Yeah.
Yeah. So that's I did that with the calculation. It was under workings. I should have brought that into the main paper as a calculation. This is how we worked it out. 18 million. 60% was for 95 million. So 8% was for 12.7. So the gain was 5.3 million, but it should not be reflected in the P&L. It must be reflected in the other components of equity because it's not a sale of a subsidiary. It's a sub to sub. Still, it's a subsidiary. Right?
Okay.
So that's all right. So I sent you another question today. I think it was a 25-mark question.
Yes.
Yeah.
Aspire.
Yeah. So we will start off that one tomorrow.
Okay.
What I'm going to do is I'll pick up some questions for you, particularly on the consolidation. We will do more questions on the P&L, but I'll pick up 1 or 2 questions and send it to you so that you can start on some of those.
Okay. Yeah. Okay.
Right. So tomorrow also we have a class, I think, no?
Yes, we do. Yeah.
Yeah. So tomorrow also we'll meet at the, normal time we can meet it tomorrow, and we will go through this question tomorrow.
Yes. Okay then. Thank you.
Thanks, Fiona. Take care. Bye.
Have a good day. Bye.
Bye. Bye.